Working? Yeah, okay, good. Okay, I want to call your attention to two articles in the Wall Street Journal which are relevant to what we're going to be doing here and some of the messages I'm trying to convey. The first is this article on GE. GE puts break up on the table. So you may remember that when the discussion of merger waves came up, the conglomerate wave accounted for first a merger wave in the 1950s when they were put together, and then a merger wave in the 70s and 80s when they were busted up. And we discussed in a brief way, which we'll discuss in more detail, the theory of conglomerates, why they arose when they did, and why that theory was thought to be a failure, leading to the bust-ups in the 70s and the 80s. And today, you find firms very much taken with the idea of focus. So a firm in multiple businesses is frowned upon on the theory that the informational superiority assumption of management with the headquarters with the fancy computers being able to oversee businesses in different areas, that theory, which fueled the conglomerate wave of the 50s and 60s, was thought to be a failure, and it led to the bust-ups. The exception always was GE, which was the conglomerate that had figured out how to do it. And GE had a series of very famous CEOs. Jack Welch is still around and still promoting his various theories. And GE was famous for its management development, and GE alums have gone, when they didn't become the CEO, they've gone to head many other large firms. And GE was thought to be the one firm that actually, exception that proved the rule, that a really well-managed business, a conglomerate business, actually could succeed. And today's story, GE puts a break up on the table. So, that's a powerful demonstration of something. And it's a story worth reading. And when we remember it, because when we discuss this in a more detailed way later, I'll refer back to this event. Second article. Anybody watch New York One, by the way? There's a guy who has papers in the morning, and he reads what's in the news. But I'm not going to do this every day. Anyway, so this is basically, this article on the B section discusses the cash that firms will have as a result of the special incentives to bring back earnings that had been stashed overseas because of the U.S. System of worldwide taxation, which is now being undone. Anyway, so here you find out where the money has been, who has the money, and who's going to be bringing it back to the U.S. So, why is this an article that an aspiring M&A lawyer would want to read? It's because, as I said, money back in the U.S. is going to be burning a hole in the CEO pocket. So if you're thinking about firms that are likely going to be acquirers, firms that are about to bring back a huge amount of cash, I'd say they are thinking about it, right? Again, as I said, they have the choice of giving it away to their employees, and apart from the PR value of the one-time bonus, I don't think that's going to happen, at least not in an amount to make a serious dent in the cash that's coming back. They could give it to the shareholders, and you'll see a lot of that. Stock buybacks will be the mechanism of choice because it's a one-time thing. Doesn't create expectations that an increase in dividend payouts would. Or they can engage in M&A, strategic M&A. This is their big chance. And so, again, if you're thinking like a deal lawyer, and you have some clients who are prospective M&A buyers, you might think that as you look on the list of who's got money coming back, you might think about how to arrange your drink schedule to make sure to touch base with the M&A person at a prospective buyer who happens to be on the client list, or you would want to be on the client list. So if you're thinking about how to make a little rain, you look where the clouds are forming, right? And again, and this kind of article is sort of some evidence about this. And the point is, it's, again, for those who are thinking in a long-term future way, how do you convey sophistication to seniors at sort of being aware of developments like this which could have an impact on actions that your clients may be about to take, and you might want to be ready for them. Okay, so end of little press story for the day. But as I said, I suspect there will be lots of M&A stories to tell this spring. So what do I want to do for this class? First, there are a few slides from 2017 M&A activity which I think are important to focus on. We'll do that. Then we'll turn to looking at the internal drivers of two particular deals. One, Boeing-McDonnell deal on the one hand, and then the Time Warner saga on the other. Time Warner AOL. We'll spend most of the time on Time Warner AOL. And part of the point here is, again, it's one of the themes of the course, is as we look at the cases, we'll want to appreciate the transactions. What motivates the transactions that give rise to the cases and to the strategy that we see reflected in the cases. And so, in a sense, going through the Boeing story and in more detail on Time Warner AOL is a way to give an introduction to that. But before we do those stories, I'll say a little bit about what we're going to do next week. All right, so let's turn to the slides. Chris, am I? Oh, wait. No, okay. I think I want to. Okay, all right. So, this is, I want you to look at this second chart, bid premiums matrix, it's called. These are all in your materials, right? And so what you see here in this chart, hope it comes through, is the premium, that is to say the difference between the final bid price for target and the unperturbed market price of the target, which is to say the target's price before news hit the stock market of the prospective bid. What's the premium? What's the percentage add-on associated with the deal? And the way the matrix is set up here, and it's kind of fascinating, there's kind of a worldwide average, but it's also, you see that sophisticated parties think of markets as, in effect, M&A markets as sort of a regional, Americas, USA, Canada, basically Europe and the Middle East. I'm sorry, EMA, that's the Middle East mostly. Then Europe, the UK. So the markets are broken up according to what sophisticated parties think is a specific M&A market. And then what you further see is by the industry group, consumer products, energy and power, healthcare, media and entertainment. And so you basically see that these different cells describe sort of the distinctiveness of the markets in general. But what you can also tell, first, is have the premiums been going up or down year against year, which gives you some measure as to how the intense the competitive forces are for M&A. And secondly, what you can see also is that the range, the premium range, is all in the 20s. The 20s may be the low 30s for the most part. But basically, it seemed that at this period of time, the premium that an acquirer could expect to pay for a target was in the, the 20 to 25% range. So, well, that's a fact worth knowing if you're thinking about how to put together a bid for a target. And similarly, if you're giving advice to the target board, what's the reasonable best that you could get if you were to try to arrange a competitive counteroffer, right? So you get a sense as to what the economics are, which will influence not only the strategy that you advise the acquirer board, but also the target board. So basically, if your acquirer board is offering a 40% premium over the target's unaffected price, you're thinking, maybe my guys are overpaying based on a chart like this, right? And similarly, if the target board, which has got a 28% premium offer, is sort of thinking, wait a minute, we're being lowballed. We've got to resist, we've got to put a pill in place, etc. This provides data in which, again, you're advising the board on its fiduciary duty. You can say, you guys have been smoking some stuff because, the chance that you're going to get 45%, the market doesn't seem to suggest that. The point I want to make is that being fluent in the data that comes rolling out like this is not just, so you become, better at the drinks that I was describing that you might want to have with a client in rain-making mode, but rather it affects the advice that you're able to give. Because you have sort of evidence as to whether the board, depending on which side you are, is behaving in what seems to be, you know, a market-supported way or not. And yes, maybe there's a reason why we should reject a 42% premium offer, right? Even though the market says, wow, that's a blowout bid. But then you're at the next stage, you're able to say, well, you gotta, the courts may want you to come up with a story. The shareholders will want you to come up with a story. And it better be a good one in light of what seems to be the evidence out there. And so the point I want to make is again, having access, knowing this kind of information exists, having access to it, it's part of what a lawyer does. All right, so let me just where are we? Okay, so all right. Here's another fact that's sort of neat, right? So look at the top right-hand chart, which again, you have this, this is part of the materials that are for the first class. But what this chart does, it describes, it gives a measure of worldwide announced buy-side financial sponsor activity. So remember how I described the two sorts of buyers other than China. There's a financial buyer and there is a strategic buyer. And what this chart gives us data on is just how important financial buyers are to the overall M&A market relative to strategic buyers. And what you see is both the dollar valuations or the dollar volume of financial buyers, and you also get from the line some sense as to the relative importance, the percentage of financial buyers in the overall M&A market. And what you see is that, again, in recent years, the fluctuation has been between roughly 16 and 18%. So again, what it tells you is that most M&A is done by strategic buyers. There are some financial buyers out there, but most M&A throughout the world is done by strategic buyers. And so in a sense, once again, if you're advising a target board that's received an offer from a strategic buyer, which it thinks will undervalue the firm and it's waiting for a financial buyer to show up, you have some ideas to the prevalence of financial buyers who might compete on different grounds to overall strategic buyers in the marketplace in question. Okay, the final point I want to make with this information, there's a lot more that we might do, but relates to leverage buyouts as a percentage of U.S. M&A activity. And it's a little hard to see unless we were to turn the lights off. But what you'll see, again, this similarly gives the dollar volume of leverage buyout activity relative to non-leverage buyout. I'll explain that in a minute. And the percentage that leverage buyouts are of the overall deal market. So what is a leverage buyout? We will discuss this in a lot more detail later, but roughly speaking, a leverage buyout is one, it's a financial buyer doing it, but B, in terms of the merger consideration, the ratio of debt to stock dramatically favors debt. So imagine that the merger price is $50 a share. In a leveraged buyout, it would not be uncommon to think that of the purchase price, how is the purchase price financed by the buyer? Maybe 40% of the purchase price will be financed by the sale of debt, which ultimately will be secured by the target's assets. So leveraged buyout, you might find a firm that is sort of the way it's financed is 10% debt, 90% stock. It might be the financing structure of that firm after a leveraged buyout might be just the reverse. And we'll discuss the reasons why that happens later. But the point I want to make is although leveraged buyouts often get a lot of attention because they're often very large, at least any single leveraged buyout, they're often used to target very large firms. They comprise a very small part of the M&A market. So they get a lot of publicity, but they may not be such a big part of M&A overall. But secondly, and this is an element we're going to keep track of in the course of the semester, one source of the gains in a leveraged buyout come from the tax treatment of the interest payments associated with debt. And again, I'll go through the details later, but the tax bill that's been passed constrains the deductibility of the interest on debt that a firm pays. So all of a sudden, some have said the reason, what are the gains in leveraged buyouts? Some have said that a significant part of the gains come from the public fisc. That is to say, the tax savings associated with the use of debt rather than stock is the source of gains. Why is that a great thing if it just means other taxpayers need to pay more? Others have said, well, no, actually, leveraged buyouts, the motive for them is not so much the tax advantages, but rather the organizational incentives associated with debt in the financing structure of the firm. And so we're about to get a test of the hypothesis as to where the gains come from a particular sort of M&A. And that'll be kind of a neat thing to observe in the course of the semester. And, you know, I don't know if you're taking detailed notes today, but part of it is when you go, and for some of you, this may sound completely what's going on here. At the end of the semester, you'll look back, and everything I've said today will seem obvious. And you'll wonder why you bothered with the notes, right? But any good course does that for half the notes. They're useless because by the time you finish the course and integrate it, you get it, right? Which is, you know, it's what education is about, really, in the core way. It's getting the intuitions. You might forget a lot of the details, but the intuitions, if the course is good, are there with you always, and you know that's the goal here. Okay. Let me think if there's anything else. I think that's it. All right. We could spend a lot more time, but time is passing. Housekeeping thing before I forget. I'm going to make live the seating chart sometime tomorrow, I suppose. So on the theory that those who are here to sample will make a a decision, and then the seating chart will be open for folks to pick their seats. If you know somebody is sitting in a seat, I don't know what the etiquette is here about the present arrangements, but any event. But there are plenty of prime orchestra seats. They're right here, right? I mean, the $200 seats are there for the taking, and I would suggest that those who are sitting in the the side orchestra move to the center, because it'll be easier for me to sort of engage with you if I don't have to swing my head from back and forth. Okay. I want to say a little bit about what we're going to do Monday. And what we're going to do is look at a specific stock purchase agreement of by a public firm of a private target. And we're going to go through that in some detail, and I want folks to be ready to tell me what the agreement says and what provisions or what work they're doing in the agreement. And as part of that, you should read with care the readings I've put in on adverse selection and moral hazard. So how many have had previous study of adverse selection and moral hazard? How many are very familiar with these ideas? So a lot of you are not, right? I mean, is that fair to say? All right. So let me just give a couple minutes on that now, because I don't want to be rushed at the end, because this is important. So there are lots of ways to think about the details of an M&A agreement, right? Figure out how to draft them, whatever, the fine grain. But the perspective I want to offer is different, which is why are the provisions in the M&A agreement there that we see? Now, obviously, some of it is there because it describes the transaction that's going to occur. But what work are the reps and the warranties doing? Why do we see a lot of attention to, for example, the payout of the seller in the case of a private target? And the reason I want to suggest you're better able to understand those provisions if you have a little theory under your belt, and the relevant theory really is drawn from the insurance literature, the issues of adverse selection and moral hazard. So, briefly put, and again, there's a reading that will explain this, so I'm not going to go through it all now, but briefly put, what adverse selection is about is the fact that one party to the transaction has information that the other one party to the transaction has information about him or herself that the other party to the transaction does not have, and the inclination of the other party will be to assume the worst. So the classic way that this presents itself, and we've seen it discussed in the public space, is in the insurance markets. So assume we have a situation in which not everybody needs to take out insurance, health insurance, right? In which it's an optional thing as to whether you will buy insurance. I think I've heard some discussion about that recently, right? The mandate is gone. So, what do we know? What does adverse selection teach? It says that the parties who, in a world in which not everybody needs to buy insurance, the parties most likely to buy insurance are those who know that they present higher than average health risk. People who think of themselves as presenting lower than average health risks might not buy insurance. So you're an insurer, and you're trying to set rates. And you know, and you're facing a pool of people who have bought insurance. What adverse selection teaches is that the average risks of the pool are going to be considerably high. The average health risks of the pool are going to be considerably higher than the average health risks for the community generally. And so you will set rates higher than the average health risk of the whole community. Problem with that is that leads some people who were thinking about taking out insurance to reevaluate their insurance decision, saying, wait a minute, I present slightly above average risk, maybe, but wow, premiums like that, I don't present that sort of risk. So they will drop out of the insurance pool. So as the premiums, the point is, as the premiums escalate in that world under adverse selection, the insurer will increasingly expect the riskiness of the pool to go up, which requires it in the next period to raise premiums, which leads to the pool unraveling. So this issue of information asymmetry, of information disparity, of one party not knowing the information about itself that the other party has, leads to a breakdown in bargaining. Because in the end, the insurer offers a premium price that nobody except the most desperate will want to pay. And it means that almost everybody else in the pool can't get insurance at all. Right? So this arises commonly in M&A. The seller wants to sell. And presumably, the question is, well, I mean, what does the seller, why is the seller selling? Is the seller selling because he or she wants to, to retire, go to Florida, etc.? Or maybe because the business has seen its last good days and it's about to fall off a cliff. Or there's some undisclosed environmental issue, or, all the reasons, the things about the business which the seller knows, the buyer doesn't, and the buyer fears. And if there isn't a good way to handle that, the price that the buyer offers will be one that the seller would never accept because of this issue of adverse selection. So you'll have no M&A taking place. So, reps and warranties are effort to eliminate the issue of adverse selection in ways that maybe now are sort of obvious, right? If you claim the business is of a certain type, has a certain quality, has certain sales, etc., and you face legal liability if you are wrong, if you're false, then in effect the penalty you face for being wrong means that your statement that this is a great business is credible, and therefore the buyer's price will be one that you would be willing to accept. the point I want to make is to understand the function of reps and warranties benefits from doing a little bit of economic and law and economic theory, and I've given you the readings for that. And similarly, we're going to discuss a little bit about moral hazard. Suppose the seller is a person, and she's going to remain as CEO for some period of time after the sale, if only to facilitate a transition. What the buyer might be concerned about is that the seller, who no longer owns the business, who no longer gets the profits from the business, will essentially move to Florida while she's nevertheless, supposed to be the CEO. So that's a problem of moral hazard. People, because they have insurance, as it were, we can put in insurance terms, think about buying theft insurance, auto theft insurance. So whereas before you bought insurance, you might have been taking care to always garage your car at night in the safest garage you know. After you have insurance, who knows? You may park on Riverside Drive with the keys and the steering wheel and the windows rolled down, right? Because the cost because the loss of that car from theft is now going to be borne by an insurer as opposed to you. That's kind of giving you a cartoon version of moral hazard. People's behavior changes because, in effect, the risk of a bad outcome is shifted to another party. The CEO in my story, she may stop working the 80-hour weeks and work, shockingly, a 40-hour week now that she sold the business, and somebody else is going to get profits and loss. How do you control that? Again, there are going to be provisions in the agreement that will try to control it, but I just want you to have the framework to understand why some of the stuff in that agreement is the way it is, and we will discuss that in more detail next week. All right, so let's turn to our cases here. Boeing and McDonnell Douglas. This is kind of a simple story, right? What were the motives and what was the issue? The motives, Boeing and McDonnell both made cars. They both made planes, right? But as of, I guess, this particular case is a 1997 story, as of the time of the merger, Boeing's business was 80% commercial. I mean, anybody ever heard of a Boeing 747? It was 80% commercial and 20% defense. McDonnell Douglas had a commercial arm, the MD-8 or the MD-9. I remember flying in those. Had a commercial arm. It had a defense arm as well. And it made no money from its commercial planes. It made all of its money from defense. So Boeing had thriving commercial business. It had a defense business. McDonnell had a limping commercial business. It had a defense business. The problem was, and this was at a time period after the fall of the Berlin Wall and at a time when, peace seemed to reign throughout the world, the defense business was shrinking in a rapid way. And McDonnell obviously faced severe threat to its business because as the defense business shrank, earnings would go down. Boeing, of course, would compete for the defense business, but ultimately the industry was consolidating. On the commercial side, the Airbus consortium was really taking market share away from both the U.S. makers. The airline business is a cyclical business in the extreme. So they decided that there was the logic here called for merger. Defense was really consolidating. Commercial was a cyclical business. It made sense to put these two firms together. The issue was price. And part of what the story is about is you know, they thought the logic made sense, but each of them, but they couldn't agree initially on price. What happened is that over time it became very clear that McDonnell was facing a very difficult future scenario, and in effect, its board got realistic about the price that it could expect, and that led to a closing of the deal. So there's an interesting fact here that I want you folks to give me an answer on. So Boeing paid a 20% premium for McDonnell Douglas. Okay, so McDonnell Douglas shareholders got plus 21% over the unaffected market price for their shares. After the deal was announced, Boeing's stock price went up 4%. What do we infer from the market's response, the market's reaction to the announcement of the deal? What are we to infer? Ideas? Anybody have an idea? I will, let's see. Is David Saltzman here? David, so what is the market saying? I mean, is there any information relevant in the market reaction to the 4% increase in Boeing's stock price? Mike. Thank you.
Given the stock price went up, I assume the market thought the deal was favorable to Boeing.
Could you say a little bit more? Favorable, what do you mean?
That they acquired a company that would, I guess, positively impact their business in the future, and that's why the stock price went up.
Okay, let me ask you to wear a hat, the lawyer for the McDonnell shareholders. First, would your clients have any reason to be concerned? I mean, they got a 21% gain upon the announcement of the deal. Boeing's stock price went up 4%.
Well, I guess they may think that the premium that was paid was too low.
Say more?
Given the way that the market reacted, maybe they think that they should have received a higher premium on their shares.
Yeah. So basically, one way to think of it is the merger of these firms is going to create value, a surplus. That's a good thing. But potentially from a shareholder point of view, you would care a lot about the division of the surplus, right? And so if you're a shareholder of McDonald, and the market was telling you that, hey, the Boeing shareholders really did well, you might think that your board did not do a great job as a bargaining agent for you as a shareholder, right? And so, in effect, we're kind of doing a single firm event study here. And later on, I'm going to ask you to do studies of this sort. But to push this out a little bit further, one way to think about the way to assess the surplus and the division and who's winning, who's losing, would be to try to figure out what was the market cap, that is to say the market value of McDonald's stock, number of shares outstanding times price per share. What was the market cap of McDonald's before the bid? What's the value created for the shareholders of McDonald's by the bid? That's 21% times the prior market cap. That's a dollar amount. What's the change in the market cap of Boeing in respect of the merger? That can also be dollarized in exactly the same way. And then you can kind of figure out, who got which dollars. And form a basis as to thinking whether the acquirer overpaid and by how much if the acquirer's stock price went down, which is not uncommon. Or maybe the acquirer did really great if the stock price went up. David, how would you argue that as a shareholder you shouldn't care as to whether Boeing's stock price went up by 4% or not?
Well, you could argue that there are gains to be had in the long term because it wasn't the acquisition a share for share exchange. Right, it was $1 for I think 67 cents.
That's a shrewd point. Let's make it. That pushes in a more difficult direction. For the moment, let's assume it was paid in cash. Assume it wasn't a stock exchange. Paid in cash. So you're taking your premium and you're walking away, and the other shareholders are getting, or the shareholders of Boeing are getting a 4% rise.
I think so they no longer have the shareholders then in McDonald's no longer have any interest in Boeing, so
right.
I guess,
is it the case that the shareholders of McDonald's have nothing at stake in Boeing?
In this situation or in
in the real world?
Well, they have a case if Boeing is a industry leader. They have an impact across the entire airline industry.
Right. I'm right. I don't mean to ask, what am I thinking, but anybody have a different idea about this? In today's market, how would you argue that the shareholders of McDonald's shouldn't care about the 4% that Boeing got? The temptation is to say, you'll figure it out at some point. Right. Think about index funds. Think about diversified investing. If the typical investor like you and me is going to hold his or her shares through, a mutual fund and a diversified stock fund, maybe even an index fund which holds all the shares in the market, then, the only thing, question mark, right? This is going to be an issue we come back to. Is the only thing we care about whether the deal creates value. If it has negative synergies, if it's value destructive, that's a bad thing, right? But if we're fully diversified, then in the pure case where we're an index fund holder, then, we're what we lose out of the right hand, we gain on the left hand. So truly, do we care, right? We might think that that particular management team has signaled that it's not a great management team, and we'll know that for the next proxy battle, but that's a different story. But as to whether we should vote for the merger knowing that it benefits Boeing more than us, maybe we don't care. And indeed, even if we don't hold an index fund, even if we have even if we invest through active hedge funds or active mutual, it's not going to be a hedge fund, active mutual fund, which may be underweight in Boeing and hold only McDonald's shares. You might think that the point is, on average, ex ante, we're going to be holding the shares of the winner as often as the shares of the loser, probably, if we're well diversified. And so once again, in expectation, we have as big a chance as winning as losing. The only thing we care about is whether the parties, when they do a merger, are creating value. Value additivity as opposed to value destructivity. Anyway, I just put that out there, for thought, right? Because obviously, from another perspective, it matters a lot as to the division of the takeover gains between the bidder and the target. Half this course is about that, right? The effort of the bidder and the target to fight over the distribution of those gains. Deal protection is a lot about locking into place an agreed upon division of the surplus between bidder and target. In part because management teams think of playing on one side of the field, right? But when we're coming up with legal rules, should the legal rules be from the perspective, ex ante, from the perspective of the diversified shareholder who cares mostly about the creation of the surplus rather than its division, or should they be mostly about taking care of the management teams, which are going to be fighting for their side share of the spoils? Anyway, question mark. Okay, I want to spend the rest of the time discussing the Time Warner scenarios. And now, I assume people in the basic course, the corpse classes, you've read the Time Warner case. I mean, how many have not read the Time Warner case? So a small group, but some. But, well, we'll read it. I mean, don't worry. But I'm just saying some of this, when you read it for today, might have seemed kind of familiar. So there are, in the Time Warner scenario itself, there are 4 different pieces that I want to advert to now. One of which is what was the economic motive, the logic of putting together Time and Warner. Secondly, what were the so-called social issues? Because there's a logic of economics, but there's also the personalities involved. People's own ambitions get tied up into whether deals are done and how they are done. I mean, in a way, it's so obvious to say, but when you're actually working for a client who's supposed to be, and your client's supposed to be the firm, the entity, right? And you see some CEO who is thinking about him or herself, you realize, and what's my role going to be after the merger? The social issues, as they're called in the trade, are quite important, and we see them here in the Time Warner case. The third issue is the shareholders. What role is there for the shareholders? And do the shareholders have the last say, and what are the ways to limit their say? And the fourth is the courts. How have the courts, from one perspective, policed the behavior of the parties? The other way is to kind of put it is intruded upon the behavior of the parties. So that's the Time Warner case. Then there is Time AOL, which was a creature, sort of a high creature, a creature of the high watermark of the dot-com bubble, and everybody who looks at the Time AOL scenario asks, well, what were they thinking? When you think about the parties who put together Time AOL in a critical way, think about your friends who bought Bitcoin at 20,000, and what were they thinking, right? He says before Bitcoin goes to 50,000, right? But it's always easy after the fact to tell when there was a bubble. Right now, I mean, the idea that the Dow, without hesitation, marches from 20,000 to 26,000 on the tax bill is, I mean, that, of course, I mean, you cut taxes by 20%, that's going to increase your after-tax earnings, and so that will account for a significant rise in stock prices because, you're giving less to the government. But even so, that presumably was impounded in expectations a long time before it happened. So the march forward here, we're kind of, there's a very famous Roadrunner cartoon in which the Roadrunner goes off the cliff. Everybody remember this, at least in the telling of it, even if you haven't seen it as a kid. The Roadrunner goes off the cliff, and it's only when the Roadrunner looks down that the collapse occurs. So who knows? I don't want to say. But what were they thinking? Time AOL is always easier to say when it's clear that this incredibly inventive thing, putting these two firms together, was a complete fiasco. All right, so after Time AOL, what's sort of neat is to see the way the logic, the economics of it, work themselves out. Time AOL is sort of a business failure in many respects. AOL is kind of spun off, and the materials describe what happens with AOL, right? In different incarnations, right? And we'll speak to that a little bit. But then Time Warner goes on, and the book doesn't really, the materials don't follow Time Warner so much. But Time Warner, after the merger, after the Time and Warner merger, consisted of sort of the content provision, books and movies, and cable, pipes, as it were. So Time Warner split off from Time Warner Cable. And Time Warner Cable merges. Initially, there's a merger with Time Warner Cable is the second biggest cable firm in the U.S. There was a proposed merger with Comcast of Philadelphia, which was the biggest. Antitrust authorities intervened. That merger, horizontal merger, never happened. Later, Time Warner Cable was acquired by Charter Communications and now with Spectrum, right? So the point is, Time and Warner, which created the content provider and a cable business. The cable business is spun off, and then there's a merger later. And Time Warner, the content provider, mushes forward. You may remember from the telling that the critical feature of the Time Warner merger, the reason that Time had to resist Paramount's overture was because of Time culture. Well, you know, a couple decades later, Time is taken over by Meredith, which is a publisher of you know, middlebrow magazines associated with the Midwest, not the uber sophistication of Manhattan that Time itself had embodied, right? So part of what's kind of neat about the story, and again, this is you know, one of the intuitions I hope you'll really get is that a lot of M&A activity is a response to a change in the world. The world changes, and so the logic of different businesses being held together changes. And we'll discuss that a little bit in the story here. Okay. So let's discuss Time and Warner. There was a merger there. And there was presumably, well, so David, what were the motives for the merger between Time and Warner? Why did the management teams of those firms want to do it? What did they see the potential sources of the surplus of value creation associated with the merger?
So Time was the content provider while Warner had the pipelines, right, to, I guess, communicate that content.
Well, was Time only a content provider, and was Warner only...
Well, they had, I guess, the classic like intellectual property assets as well with Warner. So I just think that they thought that there was some synergy to be gained by combining.
Well, there were synergies, but Time also had cable, right?
I think it had maybe a couple of channels, but maybe...
Well, it had some franchises. I mean, it had the rights to the cable business of some places, as well as channels, I think. And it obviously had some of the content. What did Warner have?
Warner had...
Well, Warner Brothers.
Yeah, they make movies. I mean, they're records, but they have their yeah, like you said, Warner Brothers.
And what else do they have?
Movies, television programs, records, magazines. It sells and pays TV through its home box office. I guess Cinemax it owns.
Right.
Bugs Bunny.
And they had cable, right? I mean, Warner also had some cable.
Yeah, owns cable TV systems.
Right. And so... what were, I mean, roughly speaking, what were the two sources? Let me put it differently. So one can think of the merger as having a horizontal dimension and also a vertical dimension. What was the horizontal dimension of the merger?
I mean, they both were...
They both had cable systems, right?
Yeah.
Okay, so they basically, instead of covering, Now, I mean, each cable system is exclusive to a metropolitan area. It's not, I mean, it's a natural monopoly when it comes to a specific area, right? It's not like in Manhattan you have the option between having a Spectrum cable system or, you know, a Comcast cable system, right? So they had, in any given area, they had a sort of a natural monopoly, but you know, if you have cable systems in LA and cable systems in New York City, and you can, in a horizontal way, build a sort of a national cable network, what are the potential sources of synergy? Why does that create value, given that, as I've said, each locality has already got its own cable system, and you can't get more than one? What's the source of value creation?
Well, you'd be creating, I guess, a more national cable provider as opposed to these individual localized providers, which I guess would maybe make things cheaper for them to do.
Well, what things?
The actual providing of cable, maybe
Well, I mean, you know, if you lay cable in Manhattan, how does that make it less expensive to lay cable in LA?
probably, I mean, they're distinct probably.
What would be the sources of value creation here, of synergies, of cost savings, if you want to put it that way? Ideas? Yeah. You're
Kevin.
Kevin.
Yeah. One might be like customer service. You can only have, like, you can cut down on the number of people you would need for that, like administrative things, or even like laying cable. Maybe you can get a lower price because you're buying more.
Okay, so good ideas. So basically, the service thing is a back office. Maybe you can anticipate. Think of it this way: you need to take account of surges if the service goes down, right? So you need to have a service office big enough that when the cable breaks, it can attend to the complaints without people going crazy because they're on a 20-minute hold time. But breakdowns of cable are probably idiosyncratic, to use a fancy term. They're going to occur in a non-uniform way throughout a national cable system because each cable is its own local monopoly. So if things break down in New York, probably at the same time, they're not going to be breaking down in LA. So if you have a back office that is large enough to handle the surge in a single community, you only need one of those, right? Instead of separately having the big back office in New York for the surge and the big back office in LA for the service surge, you can have one office because the chances that you have a surge in both places is very low. And so all of a sudden you can hire fewer folks to man the phones or whatever. And then Kevin said, well, look, you're going to be buying things. Cable, for example. And if you're going to be buying, cable for a national system, you're going to be able to bargain better with the contractors who supply cable, who maybe install cable, right? I mean, you've got bargaining power because you control a lot of business, and just your common experience, you're able to drive a better bargain on price, terms, delivery, being the first person who gets service, etc. Right? What about the advertising element here, Kevin? What do you think?
Well, I guess on some level the advertising is probably going to be local, but you can probably, again, national advertising can get, if you're nationally advertising, that is more effective I suppose. And
Well, if you're bargaining with, you know,
Yeah.
GM who's rolling out the, you know, the 2018s and who wants a national footprint, right? I mean, instead of GM being able to, the single big buyer buying with local cable sellers in LA and New York and Chicago, it's dealing with the single counterparty. Time Warner Cable, and so presumably it's going to be able. I mean, again, it's going to shift the bargaining theory here. So David, what about the vertical dimensions? What about the vertical sources of gain in the merger? What were they thinking?
So I think, well, Time had a interest in breaking into, I guess, the field, or this field, because they're mainly as their publishing company, right? So
Okay.
they had an interest in, I guess, expanding their business in the cable industry. So they thought that they could leverage some of the existing stuff that they do with their magazine with the cable network.
And what about Warner? What was the vertical dimension for Warner?
That, I guess, I mean, Warner would be adding Time and the publishing and all of its assets associated with that.
Well, what was the content that Warner created?
What was the content that they created?
Yeah. Warner Brothers, right? Movies and television.
Yeah. I mean,
Right,
TV shows.
and so each of Time and Warner thought that the content that they created would more naturally efficiently flow through the distribution network of a national cable system that the merger was creating. So the vertical dimension was, if you have a cable system, you need the content to run through your cable system. You've got to buy that from a content provider. So the argument was, if you had the content provider and the distribution network under common ownership, that would create value because of the more efficient ways that content could be obtained and pushed through the distribution system. So Kevin, why do you need a merger to obtain the content for your cable system? What is the alternative to merger?
it would just be buying the content from various producers.
What is the legal term for buy?
Purchase? I don't. Contract?
Aha! Yes, the duck will come down. You get $100. All right. So yeah, I mean the alternative way that the content could have been provided is by a contract from a content provider with the cable system. Well, if that is so, then what are the gains associated with merger? Why have a merger? I mean, if basically the vertical elements, and this is a question that arises all the time, right? Make or buy. In our supply chain, do we own the supplier, or do we buy, or do we have a contract with the supplier? Why did the parties think that merger would be a source of gains relative to contract when it came to the content provision?
I'm not entirely sure why they thought that. I suppose it adds stability because you know that you're going to be able to get content, and you know that you're going to be able to sell content to somebody. So on that level, it provides that.
Okay, and what's the right? So I think that's got the intuition. How do we come to the terms of a contract?
You negotiate.
Negotiate. Counterparties. Buyer, seller, bidders on either side, counterparties. And they may not agree. And there may be a bargaining breakdown that means that efficient deals will not occur. How are the terms set between the contract provider and the cable system internally, right? Because there's going to be an internal negotiation between Warner Brothers and Time Warner Cable over the price that Time Warner Cable pays to Warner Brothers for the content that it gets. If there's disagreement between the Time Warner Cable people and the contract, the Time Warner and the cable, how is that disagreement solved?
I imagine they would just go up to their boss, whoever.
Exactly
yeah.
right. Some official in the hierarchy says, this is the deal, this is how you're going to do it, and do it, right? So the advantage, or the institutional differences, advantage, who knows? The institutional difference is that the contract depends for its existence and the ability, the durability, the stability over time, because you might want to renegotiate depending on if the TV series is a success or if the star demands more money. Parties' ability to successfully negotiate to agreement. And we all know of cases where two parties, each of whom is free to walk away, the contract negotiations fail. And essentially, value is lost because of the failure to be able to agree, because one of the other parties is, a jerk or whatever. You never know. In the corporate setting, after merger, whatever, there may be some internal negotiation, but ultimately there's going to be a decider who can figure out what the internal price is going to be and mandate yes or no, this deal goes forward. And, so that might be a course of savings. Now notice the flip, on the other hand, right? The stability, what's the other side of stability? Or what's what's stability and stasis are, one person's stability is another person's being stuck, right? Suppose Warner Brothers produces junk year after year, and because the boss says, well, the content that they provide you're going to be selling, and it's not very good because Warner Brothers knows, the movie makers knows, it doesn't have to compete to sell its goods in the marketplace. It's got a captive buyer for the TV series it produces or the made-for-television movies it produces, right? So and part of, and I'll close, part of helping clients here when they're thinking about, we have a strategic business need. We need to get the content here, or we need to get IP. We need to get something. And the question is, do we obtain total control over it via a merger? We have domination that comes with hierarchy. Or do we mediate our needs through the marketplace, through negotiations for the contract, understanding the circumstances in which one or the other of these institutional arrangements will create or destroy value is a way in which lawyers can create or destroy a lot of value. And so, you know, anytime we think about a merger, the question is, well, what are the alternatives to merger? That's part of the balance. Okay, so I think we'll stop. And I mean, there's obviously a lot more to be said about all this, but it'll eventually come. The point of today is, again, to give you kind of an introduction to some of the themes that we're going to try to develop in a deeper way in the course, and to give you a sense as to some of the intuitions that I hope you'll have. Monday, we will look in a close way at the agreement. So again, and this is a different kind of reading, right? An agreement is a performative utterance, right? It's not discursive reading. It's very precise reading to understand the way that the contract provisions sort of create a little structure. So beginning of next week, look, and the seating chart will go live, and look forward to seeing you then. Oh, you're also going to get a survey about your availability for the TA sessions, because we're going to try to set some times.
I'm sitting there by myself.